Rental yield is a number that helps you figure out how much money you're making from rent compared to the property purchase price.
On paper, you could be having a profit when your property goes up in value over time.
Looking for an investment property? Here's what you need to consider before making a purchase. It's often said that owning an investment property is like running a small business. It's all about certain criteria along with a whole heap of number crunching that could make some homes a better choice than others. Today I'm here with Westpac home loan specialist Carmel Jarvis and Cate Bakos, an experienced buyer's agent from Melbourne, to get the inside track. Cate, first question, what are typically the main considerations investors should think about when evaluating a good property choice?
Well, Alice, there are a lot of factors that go into making a good investment property decision, but typically the investors that I work with are looking at dwelling quality, location, capital growth, and rental yield.
So Carmel, if we do drill down on the rental yield for a moment, how do we work this out? And what should investors be aiming for?
Yeah, so rental yield is a number, or specifically a percentage, that helps you figure out how much money you're making from rent compared to the property purchase price. So that is how much money you received in annual rental income minus the expenses like maintenance and insurance divided by the property purchase price. Then you multiply it by 100 to get the percentage. The higher the number, the better the return. As an investor, you'd typically be looking for a percentage of over 4%.
Okay, so then with capital growth, Cate, what does this mean?
Well, capital growth refers to the increase in value of the asset over time. So on paper, you could be having a profit when your property goes up in value over time. And as an example, if you purchased it for $500,000 and then a few years later it's worth $800,000, then the capital growth that you've experienced over that time is $300,000.
So in your opinion then, Cate, rental yield versus capital growth, what should investors chase?
Well, in an ideal world, we'd all love to get both, but it doesn't quite go that way. It's a bit of a holy grail. Capital growth is really important for someone who is looking for that gain, and it might be an equity gain, not necessarily a profit that they wish to crystallise. So when they use that equity, they can go on to borrow further funds to purchase more investment properties. But rental yield does play an important point because that will determine the holding costs of the property. If you're getting more rent for the property, then the amount that you're having to pay out of your own pocket will be diminished. And finding that balance is really important because everybody's circumstances are different.
Carmel, how can people assess what location and property could be right for investment?
Well, there are certainly criteria that will make some locations more appealing than others. And one way to assess the data is by using Westpac's property market research tool, because it can show you things like how much prices have gone up in the past, who's renting in the area, and whether it's in a flood or fire zone. It can help you determine which area could suit your specific investment strategy.
So, Cate, in your experience, are investors trying to get positively geared properties, and what does that actually mean?
I think every investor would love the idea of a positively geared property, but it's not a reality for most properties. Positively geared means that the rent is covering all of the expenses plus some. So they're making a profit after they've purchased the property and they've leased it out. And that is very unusual, particularly for a higher capital growth asset. We tend to find that most investment properties start off as negatively geared. So that means that the investor needs to be prepared to cover that shortfall on an ongoing basis.
Carmel, what's your top tip for investors when it comes to thinking about strategy?
Yeah, investors should start thinking about their strategy early. So what they hope to achieve from this journey and what loan type best suits their financial situation. Reaching out to Westpac as well as a financial advisor can really help them understand their options and guide their decision making.
And Cate, what about you? What about from your end?
Knowing your budget is really important because once you've understood what your obligations are from week to week, month to month, and what your savings capacity is, you can apportion the right amount of money towards your property investment journey so that you'll get a fantastic outcome.
Look, that's all really great advice. I think the big takeaway here has been that any property decisions investors make will always come down to their individual circumstances and strategy.
Yeah, that's exactly right.
Thanks for listening to The Buyer's Handbook. Join us next time for more answers on the topics that matter most. For more help with your property journey, head to the Westpac How to Buy Hub on realestate.com.au. Eligibility, conditions, credit criteria, fees and charges apply. Residential lending is not available for non-Australian resident borrowers. This information is general in nature and has been prepared without taking your personal objectives, circumstances and needs into account. You should consider the appropriateness of the information to your own circumstances and, if necessary, seek appropriate professional advice.
Real Talk acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, air and community. We pay our respects to elders past and present.